Head it honk. Oh, hey, welcome to today's podcast. We are joined by Cyril, contributor at FFX, but like major contributor. I know we just talked about this before the show started. They don't have roles over there, so it's hard to give him like a official title that he deserves. So we'll just call him King of FFX for now, and then of course he could correct that later. Cyril, thank you for joining us today.
It's a pleasure. Thank you for having me.
Yeah, absolutely. People probably know that I have been using you guys' new FFX V2 for some leverage positions. I actually am up 50 bips on my BTC leverage. So like we're, making back some gains that I may have lost. We are in the throes of weird times in crypto. Before we jump into like what's going on over at FFX, I do want to give Patrick and Mara a chance to help me understand what's going on in the world of macro crypto, because I don't understand it. There's like a tariff war and that's kind of getting alleviated, and then Trump's been saying bullish bearish things at the same time every time he speaks, and then apparently he wants to put everyone in a lead room to avoid signal leaks. I don't know if that's related, but it felt like it could have been. Patrick, what are you seeing out there?
Yeah, so I mean, things are definitely looking better than last week, but that's the market we're in, where things are constantly chopping around. So taking a step back, like even before looking at macro, there's a lot of really good news for crypto right now. Crypto specifically, you have the stablecoin bill being debated right now, which would create a regulatory framework for stablecoins. Simultaneously, you have, and I know it's almost a meme right now, like how everyone's so excited about stablecoins, but you have the supply going basically parabolic, increasing by more than $1 billion a day. Recently, you have Fidelity, just I think 6 or 7 hours ago, I saw announced they're launching their own stablecoin. You have Sam Altman looking at a stablecoin wallet for WorldCoin, and then I mean you have, of course, Trump also launched a stablecoin yesterday, or his company launched a stablecoin. So you have all these major players getting involved that way, and so there's a lot of reasons to be excited about it. But in terms of macro, I mean, I think it's kind of a lot of the same old stuff. Do
you still think we're heading towards a recession?
I do still.
Any more in the spectrum of like a hard yes to a hard no? Are you any more notches to the left there? Or are you still sort of like right where you were last week?
I would say, I'm with some of the signaling that the tariffs could be pulled sooner. I'm feeling a little bit less, certain that we're heading towards a recession. That being said, if you go to Polymarket, for example, the percentage is still around 35%. I personally think it's probably higher. It's always boring to be like, oh, it's 50-50, right? I personally think it's probably higher than 45%. Last week it was rated around 45%. I think that's probably pretty accurate. If you look at the Atlanta Fed, which forecasts GDP, they are still forecasting a drop in GDP for Q1, which is about to end. And then of course, 2 quarters in a row of a drop would be the definition of a recession. So I still think that we're heading towards one. I think, in terms of the mixed signaling and all that, I think my theory on what's going on is, and I know we probably don't want to get too much into macro, is that they're basically running like a private equity playbook. So they're like, they came in, they're restructuring, they're cutting costs, which always includes a lot of personnel costs. Anyone who's worked at a company that was acquired by a PE fund knows this. Cutting costs usually means people. And then they're trying to increase cash flow. So that means new revenue sources, which are, pulling all the levers they can, which in their case is oftentimes tariffs, or refinancing debt. So my theory on what's going on is they're trying to basically force the Fed to cut interest rates so they can refinance debt at a lower interest rate. And then that would have probably be the single highest impact thing that one could do to actually reduce the deficit. Because right now a huge portion of spending is actually just to finance existing debt.
Yeah, we've heard this narrative a few times. People in the dojo are like especially keen on this particular theory, which is we have outstanding debt. It's super expensive. It's at a high interest rate. We need to put at a lower interest rate. You can't just tell J Powell to do a lower interest rate. It's not really how the Fed works. So we need a reason for lower interest rate. What is that? It would be a recession. Is Trump pushing for a recession? It kind of sounds conspiratorial to say that, but of course, all the economic incentives are there for him to do it. How do you do that in a low impact way? Well, maybe we're seeing it, maybe we're not. But I've also heard that tariffs typically are like almost in most cases are not used as a revenue generating mechanism. They're typically like a domestic incentive mechanism or like, punitive. Do you think that it can I know that we're getting a little off track here, but this will be the last question I ask on this. Do you think that tariffs can be used or are often used as a revenue generating mechanism to any degree of success?
Well, I would ask you this. Do you think we're in a typical situation right now?
That is a good point. Yes.
And I mean, yes, typically they're more of a way to give domestic businesses an advantage.
Right.
But if you look at, for example, this is, again, so long ago, it's almost tough to use an example. But if you look at, say, the 1800s, like that was a major source of revenue for the U.S. government because the income tax didn't exist. A major source of revenue was tariff income.
And Trump is going to get rid of income tax. So it feels like we're just going back to the 1800s. This is wonderful.
It is interesting.
Mark, I want to get you in here real quick because as Patrick said, we just saw the launch of USD1, which is, and by the way, Cyril, if you have any opinions on this, feel free to jump in. USD1, it's a stablecoin. Trump is launching it. From my perspective, it just looks like another USDT, USDC.
Yeah. Well, just real quick to piggyback onto what Patrick was just saying, it definitely sounds, you have Bassett and Lutnick out there, pushing the narrative of like bringing in more income, like increasing the revenue stream. I think they're talking about trying to do $1 trillion is like, number they've set. It sounds like cut a trillion out of, like the federal budget and then increase the revenue by $1 trillion, which if they could pull it off would be pretty incredible. It's hard to kind of gauge how realistic that is. I don't think, tariffs alone could certainly not do that. I don't think there's just like enough, trade happening in a realistic way that they could like, raise that amount of revenue without just like stopping global trade almost entirely just because it would be so expensive to transact. There are other stuff that they're doing, right? So there's like the Trump gold card or whatever it's called. So, this is trying to encourage very high net worth people, I would assume many in the Middle East, but of course other places as well, to come and have, legal status in the United States to transact, to run businesses, to do different things. And they're trying to make this like pretty sweet deal where you don't pay global tax. It's one of the few things. If you're an American, typically you pay tax on everything that you earn anywhere in the world. But with this, you would only pay tax on your, American income, and they have other kind of benefits. So it sounds like they want to sell a bunch of these things, and maybe they have sold a bunch. So like that, at $5 million a pop, you sell a couple thousand of them, it starts scaling pretty nicely. But it'd be interesting to see how that develops. But in terms of like, the overall situation of what's going on, I've been kind of preaching the high volatility. Like I think that we're just going to see it, for months and months and months, where the administration goes very hawkish, then very dovish, back and forth. There's been lots of signaling that the April 2nd tariff deadline was going to be, very extensive, lots of tariffs across many different, countries. And that sounds more recently like they've been kind of taking a step back from that. And my overall opinion is, they're going to talk a big talk, but it's hard for any politician, for any administration to really kind of have a lot of austerity that really starts affecting their population. So maybe we're just seeing the art of the deal where like they are very strong with their words and then the actions, don't end up being, quite as aggressive as they say. But regardless, I think we're just like in for a lot of volatility. I still, I've been saying this also for a long time that I think, the regulatory situation for crypto is improving very, very rapidly. I have a lot of friends who work in TradFi, and their kind of opinion of it as a sector has dramatically changed over the last few years. And then with, of course, Trump himself really getting into the weeds of DeFi. I mean, he's got a meme coin, he's got a protocol, he's got a stable coin. I mean, he's hitting all the bases now in terms of like,
don't forget about the NFTs.
The NFTs, excuse me. Yeah, I mean, literally all the bases, right? Like what else, maybe he can launch perp decks next.
And all the gold tickets are actually going to be tokenized. So you can just buy them on chain. You're an American citizen.
You go.
That's not true. Don't
there you go. Yeah. But in terms of like USD1, it's hard to know, like, exactly how it will differentiate. And like, there has been such a proliferation of stablecoins, over the last couple of years. Some of them I think have brought really kind of interesting dynamics, especially kind of like on the yield side of things. But like, something like USD1, maybe it'll be great because it'll be kind of presidentially stamped, or maybe it will be a bit irrelevant. I remember people faded for example, PayPal dollar a lot when it first came out and said it was never going to get any traction. And not that it's been kind of just like a straight up success, uniformly everywhere, but like they have had a lot of traction on Solana. It's one of the major stablecoins on Barachain. So, in some cases, these, corporate wrapped dollars seem to have been quite a success. And I think we've seen more recent ones pop up. I think, was it Fidelity that also launched one? Anyway, I don't know. I'd love to hear Cyril's opinion on this. I mean, he is much more in depth and in the weeds in the world of stablecoins. So just trying to hear what his opinion of USD1 and this kind of general proliferation of stablecoins is would be very interesting.
Yeah, FFX literally has a stablecoin. So in the world of ever-growing stables, as Patrick has said, we're at almost 10 billion now. You guys have one. Tell us a little bit about FX USD. And then if you can, drop a little bit of FX Save Alpha, because that's like what I'm most excited about.
Oh yeah, sure, with pleasure. I don't have any strong opinion regarding USD1 to start with, because as you said, Mara, there's been so many new stablecoins around, especially with very similar designs, just T-bill backed stablecoins. And I'm not very interested into real world assets. I see the point in real world asset. I understand why there are so many, because it's probably the easiest way to deliver a scalable and stable stablecoin, and it's very profitable as well. But not too interested, because in my opinion, it's not actually DeFi. And what I'm passionate about is DeFi. It's tokenized assets, but there's no interesting mechanisms. Maybe sometimes there will be interesting tokenomics to attract liquidity and sustain it, but I'm not too interested into real world assets. And I believe that at some point users will be disappointed with one real world asset issuer or even just this kind of stablecoins, and they will be happy that there's decentralized alternatives around. And this is the purpose of USD, actually.
That's a pretty bold statement. I mean, the real world asset narrative is like the narrative of the moment. Well, I mean, I wouldn't. You say real world asset narrative, but it's also like yield bearing stablecoins, which you guys do fit into. Jason,
right.
So there's bringing tokenized assets and yields on chain, typically T-bills, and then two, there's like all the yield bearing derivatives, which people call Athena an RWA, right? SUSD, even though it's a basis trade, it's wrapped, and Muller has some opinions on whether or not it should be called a stablecoin in the first place. So FX USD, is it decentralized?
It is. It's 100% on-chain and collateralized. So in that way, it's decentralized because you can always control the backing of FX USD, and it's mostly backed by wrap staked ETH, and more recently also backed by wrapped Bitcoin. So I guess the centralized part is the wrapped Bitcoin backing, but at the moment this is the most liquid Bitcoin wrapper on Ethereum, and we're looking at other solutions in the future. So FX USD is a decentralized stablecoin, which it's probably the most capital efficient decentralized stablecoin around, because by design it's 100% collateralized, but at the protocol level it's over collateralized. So FX USD is actually a byproduct of the X positions FFX offers, and the X positions are new way to take some kind of set and forget leverage on ETH or BTC. You can get up to 7x leverage with minimal liquidation risk and no funding costs in most cases. So this is,
Talk about that. I mean, I have had a position on ETH. Don't look at my ETH P&L.
Oh, you're connected. Your wallet. Awesome.
Yeah. Again, I've been rebalanced.
Oh yeah.
For 3x leverage was dumb, but so it is. I have only paid one round of funding. I think I've had this position open for 2 months at this point, and I paid 39 cents. So 39 cents in multiple months of holding my ETH position open.
Yeah, this is why I say in most cases you don't pay funding. It can happen, but when it happens, it's very, very short.
So, and it's going to be hard to explain this. Actually, but before we go into this, Patrick, I wanted to ask you and Cyril a question, because this has been something that's been eating at me for a while, which is, there are the curve llamas and there are the DeFi llamas. So two questions coming out of this. One, why llamas in DeFi? And then two, is there any relation between these two sets of llamas?
So I'll say this. I don't know the exact background behind the name. However, the original founders of DeFi Llama, several of them came from the Curve team. So I'm guessing that's why.
So there was a progenitor of all the llamas. There was like a father or mother llama. who then had all of these.
But I actually don't know that. That's just pure speculation on my part. But I mean, it seems like it would be a pretty big coincidence, right? If several of the founders came from the Curve team.
Yeah, that's what I understood as well. Same, like a guy from the Curve team founded DeFi. I don't know.
There was also but we don't need to go. But there is on Binance Smart Chain, there was also the Alpaca protocol. Hate it or love it, people were doing like leveraged, I think pseudo delta neutral yield during Phantom's heyday and got super wrecked, myself included. But that's why you don't trust alpacas. You stick with the llamas.
The llamas, yeah.
Let's go back to the expositions because that's very interesting. Basically, you have no funding fees, no interest rate or leverage, and technically the leverage is composable because you get an X position. Can you explain for maybe all of us how is that possible that you can have a leverage position with no funding?
Yeah, sure. First, I guess people may wonder, is it free? So it's not free, obviously, but there's just an opening fee and a closing fee. So the opening fee is 0.3%, the closing fee is 0.1%. And then you can hold your position as long as you want. And you won't pay any funding in most cases, as you demonstrated it. So how do we do that? It's just that we don't have to pay fundings to counterparty because funding costs have been created to balance the demand between longs and shorts on regular pubs. And on FFX, you can only long the market now. We're building short positions, but for now there's only long positions. So the way it works, maybe I can share a couple of slides to explain how the positions are created, if you guys want. But
go ahead, do your thing. You know what you want to show better than anybody.
Yeah, probably. So let me share my screen. There we go. Can you see it? Maybe I can go back a little bit with the history of the protocol and how V1 worked and then how we built V2 X positions as you want. Oh, I can stick to the X positions.
Yeah, let's do X. I mean,
Let me start with the beginning and I'll try to be quick. So it's not too long. So FFX was created in August 23, and in the first iteration in V1, which is still live, the leverage side was leverage tokens with variable leverage, while the X positions on V2 have fixed leverage. So the way it works with V1 is that the protocol can take any yield-bearing asset and split it into a zero volatility asset, which is a stablecoin, or a leverage token, which is, in that example, was XSTEEF. So, and to do so, it will use a very simple formula, which we call the FX invariant, that says that at all times the value of the backing, which we call the reserve, is equal to the value of all stablecoins on the market and all leverage tokens on the market. And this is how we managed to calculate the value of the leverage tokens. So we started with this model. If I give you a quick example for you to understand how it works. If you imagine that there's $200 in the reserve, $100 of FX USD in the market, and $100 of leverage tokens on the market, when the price of ETH raises by 10%, the value of the reserve goes to $220. The value of FX USD stays $100 because it's a stable coin. And if you use
sharing your screen anymore, if that's what you're intended.
Oh yeah, I thought I was.
Oh yeah, I thought you were like getting ready to share your screen. I was like, okay, we can go through all this. Yeah, you're not sharing.
No, I thought I was sharing.
We're all very imaginative.
Okay, so this is the example I was telling about. So thanks for telling me. So price of ETH raises by 10%. The price of the reserve goes to 220. The price of FX USD stays 100. And if you use the invariant I told you about earlier, you can just make the difference to calculate the value of the leverage tokens. And you get $120. So in that specific example, when the price of ETH raised by 10%, the price of the leverage token raised by 20%, delivering a 2x leverage. But this is how V1 works, and you will understand that the leverage level is correlated to the distribution between the stablecoin and the leverage tokens. So it actually relies on the demand on the leverage side or the stable side. And so let me show another example. In that example, there's a lower demand on the leverage side. And if the price of ETH raises by 10%, the value of the reserve again 220, the value of the stablecoins is still 150, and using the invariant, you get $70 for the leverage tokens. In that specific example, so when there is a lower demand on the leverage side, the leverage level is 4x. So while V1 leverage tokens are very convenient tools because they deliver leverage with zero liquidation risk, there's actually no liquidation risk, no funding cost at all. So it's a good midterm investment tool. The variable leverage can be inconvenient to build, like to trade, for instance, on shorter term, or to build more complex hedging strategies and stuff like that. So this is why we released the V2 early January, and V2 mostly brings fixed leverage while keeping a liquidation protection mechanism and avoiding fundings in most cases. So this is how V2 exposition works. Let's imagine you're this little guy and you want to take 5x leverage on ETH. You can do it on BTC2 now since last week, I believe, or something. Yeah, maybe last week, I believe. Let's imagine, to stick to the same example, you have $200. You will put them in the reserve. But if you want a 5x, it means you actually want $1,000 of ETH exposure, right? But so the protocol needs it to collateralize your leverage position. So to do so, the protocol will use a flash loan. So it will borrow $800 of ETH and put them in the reserve. So it has enough collateral to open your X position. So there's now $1,000 of ETH in the reserve, and the protocol is able to open your X position, which is worth $200 because this is what you brought to the protocol. And in order to repay the flash loan, the protocol will mint $800 of FX USD and sell them to repay the flash loan in the same transaction. So this is how the protocol achieves to deliver a 5x ETH position being totally collateralized and minting a decentralized stablecoin in the process. So now the protocol has the collateral. You have the user has $200 exposition having the market exposure of the whole reserve, and there is $800 of FX USD on the market. If the price of ETH raises by 10% again, then the value of the reserve goes to 1,100. The value of all FX USD stays to $800. And using the FX invariant, you can just calculate the value of your X position, which is now $300. So you got a 50% raise when the ETH only raised by 10%, giving you a 5x. So this is how exposition works, basically.
Okay, so I have gone through this, and I think I understand. I've explained this to many people in many places.
Oh, yeah.
Which is basically, you open up let's say a 5x position. So you have $100 of USDC, you open a 5x position, or let's just say you have $100 of ETH. That makes it a little bit easier. You need $400 more of ETH to have 5x leverage. So what happens is there is a flash loan to get USDC that purchases ETH, which converts to ST, so you can get yield on that. And then FX USD is minted. That is the notional value of that ETH, so $400. And then is converted to USDC to repay the flash loan. Now there is $500 of ETH exposure from $100 principal. You are to have that leverage, which is fantastic. It's ST ETH. All that additional yield from the staking goes to the FX USD stability pool, or at least the vast majority of it. Is it all of it or the majority of it?
All the yield is going to the stability pool. You can check it in the documentation. It can be updated actually, but currently all the backing, the reserve yield goes to the stability pool, and 70% of the opening and closing fees are going to the stability pool as well.
Which is crazy because right now, like, you have 13% APR in wrap staked ETH on stablecoins. So it's a cool way to like gain exposure to ETH. Now, that I understand. The question that I always get when I'm talking to LPs is, how then does FX USD maintain its peg if opening long positions is its like primary use case, and that is inherently short FX USD?
Yeah, this is a great question, and I actually have another slide about it. Let me share my screen again. This is what I just shown. Yeah, this is to TP. This is the to take profit. This is the opposite mechanism. So actually taking profit brings buying pressure on FX USD, while, as you correctly said, opening a leverage position puts selling pressure on FX USD. So to make sure FX USD always remain pegged to the dollar, because this is what it's meant to do, there's different mechanisms. So the first one is the stability pool. So the stability pool is the main yield strategy on FFX. You can put either FX USD or USDC into the stability pool. And when you do so, you will help the protocol to keep FX USD's peg. So each time FX USD is traded below 0.997, the USDC of the stability pool will be used to buy FX USD on the market to put it back to 1, basically. And each time it's traded above 1, FX USD is sold back for USDC. And to give users incentive to pledge USDC or FX USD to the stability pool, they will earn multiple sources of yield. So as I told earlier, so you will the stability pool gets most of the exposition opening and closing fees. It will get the collateral yields, and it will also get FX and emissions. You said there's something like 13% APR right now, and there's probably, now, that's pretty new, but you can now choose if you want real yield or FX and emissions when you stake into the stability pool. So you either get wrap staked ETH yield, basically, which is 13%, or you can get FX. So this is the first.
Is this why there's a higher APR? So I was looking at Convex, because obviously Convex is where you would go to get boosted yield. And the yield over there seemed pretty nuts. It's like 33% on the CVX USD stability pool.
Oh, that's a different mechanisms, because CVX USD is a V1 stability pool.
Oh, okay. Got it.
And
there we go. 16.7%. Still.
And there's a great yield on the CVX stability pool, because staked CVX has a better yield than wrap staked ETH. So it has pretty nice inherent yield as well, but it's a very different mechanism.
Right. Yeah. Sorry, I was on Convex, fx.convex.finance. I was like, oh, every stability coin is, or stable coin is FFX. Right. So you can go into Convex though and get like 17% APR there currently.
Yeah, or you can also go to FFX and the earn section. And the best way is I don't know if you plan to put it in there the video, but I believe you have a referral code for this. When you go there, you can deposit, and when you stake your assets, you will see there's supposed to be a tooltip here. I don't know why I didn't see it, but you will be able to choose.
I don't know why you don't have it.
Let me maybe refresh. So yeah, if you look at this tooltip, for instance, you will see the different sources of yield. So current APR says only 0.35% in FXN. So yeah, at the moment, it's still a mix of FXN and wrap staked ETH. And next epoch, you'll probably get.
If you look at the bottom, it says yield in FXN. So like you could get the yield in FXN. It's 3% to 27%.
Yeah, correct. I'm sorry. I just was confused for a second. So at the moment, there's still a little bit of FX and emission on the wrap staked ETH option. So this is why you get 13%, mostly being made of real yield. So there's 12.81% made of real yield right now, and only 0.35% in FXN. If you choose the FXN emission, then you can get up to 27% APR if you have the max boost. To get the max boost, you can either VELOC FXN, just like you would do on Curve, or use Convex, which lets you benefit from their own boost, basically. So yeah, this is how it works. If you want to accumulate more FXN, you'd better choose the FXN side. If you want to accumulate more wrap staked ETH, you choose the wrap staked ETH side, basically. So back to the peg mechanism. So this is the first peg keeping mechanisms, and in most cases it works well. But there's situations when there's maybe not enough USDC liquidity in the stability pool. For instance, when there's massive leverage demand, which is not currently the case, but it can happen. So there's other peg keeping mechanisms, and in DeFi you always have to anticipate what could go wrong. So this is why we have all these different peg keeping steps. So the second one is what I call the depeg mode, and it triggers when the 42 minutes EMA of FX USD on the curve pool reaches 0.998. So it would require FX USD spec to stay around that price for a little longer than just just once. And when it happens, users cannot mint new X positions or add leverage to their X positions. So it prevents further FX USD selling pressure. Then in that case, the X positions can get a small funding charged, which is actually what it would cost them to hold that position on ARV by borrowing USDC. So it's way smaller funding that they would get on a perp, for instance, DYDX or Hyperliquid, because these fundings are way higher than DeFi fundings. It's more a borrowing cost. And all these borrowing costs, all this so-called funding is also distributed to the stability pool. So it's instantly adds like multiple dozens of APR to the stability pool to attract more USDC. That would help repegging USD. So this is why the funding is first very unlikely and most likely won't last very long. And the last resort is the redemption. So you can always redeem FX USD for $1 worth of wrap staked ETH or wrap Bitcoin. I didn't update my slides. Minus a 0.5% redeeming fee. So the hard floor for FX USD is 0.995. But in most cases, it's not relevant to use the redemption because the previous mechanisms are enough. And you'd better off just setting a limit order on CowSwap and get filled at a perfect one than redeeming FX USD, unless you're in a hurry. But in most cases, it's not relevant to redeem.
So there's a lot to, okay, that makes a lot more sense. I understood the inherent sell pressure. I understood that when you close a position and profit, it would be inherent buy pressure. And so there's a mechanism that sort of balances there as long as there's profits closing in the green. The ability to redeem, even if it's only like 0.5% fee to do so, that's huge because then there is effectively an NAV. You can redeem it. The irredeemability of stablecoins has been, I think, the biggest downfall. I'm not going to name any names because anyone who's been in DeFi for a few whiles can tell you some of the irredeemable stablecoins that may still be depegged. Whether or not that's no shade. I won't say anything, but we all know the examples. So. Very cool. Now, if you wouldn't mind, because this again is what I'm super excited for, because I'm a glutton for composability. FX Save. I was calling this staked FX USD for the longest time. It's actually called FX Save. What is it, and then why is it going to be big, or why is it going to be important?
Yeah, FX Save is going to be the tokenized stability pool. It's actually the reason why you can now choose whether you want to earn wrap staked ETH, which is real yield, or FXN, because FX Save is going to be built on the real yield side, so it won't put any selling pressure on FXN. And FX Save is a 4626 tokenized stability pool. So it's not SFX USD because it's actually backed by both FX USD and USDC, but it's called FX Save because it's probably the best DeFi savings account around because it earns real yield, which is going to be composed into more stablecoins. And so it's ready, audited, where we may release it in maybe a couple of days, couple of weeks. Just, building all the integrations because since it's a 4626, it's going to be integrated pretty much everywhere on lending markets, on yield trading protocols. So it's coming in a couple of days. So this 13% APR is going to be composed, so it's going to deliver higher APY. You won't have to handle anything, and you'll be able to borrow against, to loop it. You'll be able to buy a PT for it or to speculate on its yield, which is actually going to be very interesting because the stability pool yield is directly correlated to the protocol's TVL and volatility. The more volatility there is, the more yield there is going to be distributed to the stability pool, since the protocol will take more opening and closing fees. So the YT is going to be very interesting as well to look at.
That's one of the interesting things for me. You know, I've been, I think, for months kind of like preaching this idea of like trying to get long volatility. And like, you know, when I say that, I don't typically mean kind of like there are like volatility tokens, I guess, like things that are trying to price volatility in crypto markets. That's not actually what I mean, because I think a lot of those, at least what we have now, are not super effective and expensive. So typically, you know, I've looked at kind of these CPV tokens, your JLPs, your HLPs, you know, different LP positions to get long volatility. But I think this new product that you guys are launching may be one of the best ways of kind of expressing that, because, you know, there is going to be a lot of fees. I think if Trump keeps on moving the way he has and pumping the market and then dumping the market up and down, and people have to open and close their positions, add to positions, people are getting liquidated, unfortunately. These all sound like things that are going to benefit this. So very exciting. I'm just curious if you can tease, I mean, you kind of already did a little bit, tease the different composabilities. Steven and I both, you know, love when interesting assets like yours can be used as DeFi Lego blocks. It sounded like you said there would be a Pendle integration, so that's incredibly exciting. Any sense of like which, you know, money markets you guys might be, you know, working with? Is this kind of like integrating maybe with a Morpho or a Silo or an Aave, or, you know, what's your guys' kind of plan for rolling this out and getting it, you know, plugged into DeFi?
Yeah, Morpho is probably going to be live day one or in the following days. We're also considering Euler because it can also, the model is interesting as well. And Spectra also is going to be live day one. Pendle may take a little longer because they're very busy right now, but it should come as well. And yeah, that's it. And you mentioned like, yeah, it's actually a good tool to be long volatility while staying stable actually. And you mentioned the HLP and these kind of products. And I think it's more important to make a big difference. It's kind of the same yield sources in a way you earn from trading activity, but you're not betting against the traders. That means you're not their counterparty. We've seen the issue with the HLP, I believe, on Hyperliquid, and the JMX equivalent had problems as well a couple of days ago with this massive trader who let himself get liquidated, and it cannot happen on FFX. Like you will always stay exposed to USD, and there's no risk of capital loss on the stability pool, and that's the main difference.
Right, because you're not really a counterparty here. I mean,
Come on.
you are benefiting from the leverage because whatever the notional amount of leverage is, well, minus principal, is the amount of yield that there is going into the stability pool from the wrap stake ETH. So there is that benefit. But when traders win, the ETH that is backing it simply closes into USDC and then into FX USD.
Yeah.
So there's no detriment. So it's kind of cool that you've invented a CPV that has. It doesn't have the benefits either, because when people win, or when people lose, you don't. Well, when they close a losing position, you don't win. But when they get liquidated, you do win. So you are still long volatility. There is a benefit and tailwind to,
Yeah, and even when they close, there's a 0.1 closing fee, so you still win when they close. Yeah, it's a CPV with no CP.
You win when they close. You win when they get liquidated.
You win when they keep their position because you earn the wrap stake ETH yield. So yeah, it's a CPV without CP basically.
You really the Trump route. You're gonna win so much, you're gonna get tired of winning.
Thinking about like the Sharpe ratio of things like this, right? Like typically on these like CPV vaults, like the Hyperliquid one has quite a high Sharpe ratio because you're just dollar denominated, but it is volatile because there is downside that you can have to it. On something like JLP, the Sharpe ratio is worse because, the underlying basket is ETH and Bitcoin and Solana and different things that like are very volatile, even much more so than like the counterparty risk you're taking with HLP. It sounds like this would have even a better Sharpe ratio because, there is no downside volatility. You're just having kind of like a stable principal that is earning, a very generous yield. And once you can kind of supercharge that with, different PT plays or different leverage plays on Morpho or Euler, it sounds very, very appealing. So I'm actually very interested in this new product. I hadn't quite fully appreciated its... we need to come up with a better term because it really isn't a counterparty vault. Me and Steven love coming up with these like acronyms for things, and it sounds like yours is actually unique. So we'll have to put our heads together and think about it. Unless you have a name, I know you guys are calling it's a stability pool, right? Yeah. Like, is that the best definition of it? It's not quite the same as other stability pools that are out there.
Yeah, correct. It's not the same because I believe the first time we heard about stability pool was Liquidity V1. And this design actually gets market exposure when it liquidates the leverage positions. And it was the case on our V1, but it's not the case on V2 because it gives some kind of a liquidity buffer to make sure liquidations can happen. So the liquidators and rebalancers that handle the liquidation protection mechanism interact with the stability pool, but they have to pledge stable coins in order to process the rebalancing and liquidation. So the stability pool always stays stable and never gets market exposure. So yeah, maybe we could find another name. I don't know. Yeah.
Because people have been, I mean, I know many people have been exposed to stability pools and have, had some negative interactions with it. It's like, can be very good or moderately bad, I think is typically people experience with it. So if you do come up with a new name, might be
it's a good idea.
So people don't have that PTSD of maybe past experiences that were not so good. And especially, some way of incorporating this idea that there is not a, principal risk that you're putting up, because that is true for most of these stability pools.
Yeah, this is a great input. Thank you very much. I wrote it down.
Speaking of PTSD, I was going, I don't know if you guys saw that Andre Cronje is launching what is probably going to be an algo stable. But he was saying that at $100 million, we're going to have 87% APY. And he was like taking names for, he said, should we just name it UST? And I suggested he should name it PTS USD as a medic. Now, I would be remiss if I didn't let Patrick do some teaching here, because it's like his niche. Mara mentioned Sharpe ratio. Patrick, can you explain what Sharpe ratio is to me like I'm an idiot?
Well, that's tough. Basically, one way to think of it is it's not quite a risk-adjusted return, but it's like a way of basically measuring that. I know that was a horrible explanation that probably didn't add anything. Basically, it's the performance compared to a risk-free asset.
And Steve, I know you
in
think
this case,
you think in formulas, right? Yeah. Well, I know Steven thinks in formulas, so I'll just tell it to him. It's the expected portfolio return minus the risk-free rate. So risk-free rate could be a lot of different things. And then divided by the
right? So let's say you're getting or we'll use treasury bills. So let's say FX USD is getting what is it? It's 12% in wrap stake ETH. And the risk-free rate of T-bills 5% if we're being generous.
Yeah. Yeah. So it'd be if we do really rough math, it would be something 13% of this stability pool minus 3.5% of treasury bills divided by the standard deviation of the volatility that you might expect. And so if the volatility is very low, 1 or something like that, would mean it would have a pretty high Sharpe ratio. Whereas if you had the volatility of something like JLP, which has Bitcoin exposure, ETH exposure, Solana exposure, and then also traders profit and loss exposure, there's quite a bit of volatility that's built into that. So that was what I was
kind of increases, which means the Sharpe ratio altogether decreases.
Yeah, so this would have a very good, denominator, which would make it have a high Sharpe ratio. Whereas, something like JLP probably has a higher numerator where you could expect very high returns. JLP has been up and down, I think 30 or 40% at this point. So if you are good at trading, you could do very well in it. But there is a lot of, volatility to expect. Whereas with this product, very low volatility, but also a handsome, a double-digit stablecoin yield. So.
Thank you.
And considering the actual trading activity, which is pretty low right now, there's not I've seen a chart of trading demand on sexes, and it's down to the levels it was before Trump's election. So it's very, very low right now. And considering that, we still achieve double digits on stable coins. And when the market is up, it was even 5 times this yield.
And just to think about it this way, I mean, it's so, trading volumes are so low and open interest is kind of so down that, Athena yields have been way down. I mean, they, for example, have just been going heavily into stuff like the Sky savings rate and their wrapped version of the BlackRock treasury bills. They're going heavier into that because that is more yieldy now than what they can get with the basis trade. So hopefully when, the day when Athena yields are back at 20%, the FX yield will be 50 or something crazy like that.
Yeah, we'll see. But in my opinion, since it's 100% on-chain, it's the best risk-reward stable strategy around. I'm obviously biased because from the team, but still.
So I was thinking about this just now, which is, they say history doesn't repeat itself, it rhymes. And some people have argued that the top has been in. I think Patrick has suggested that if we're heading towards a recession, maybe the top has hit. Hopefully we haven't peaked yet, but if we did, last cycle, we had the top, and then there was a flocking towards Luna and UST specifically. Now we have Sonic making a comeback, and not only, Sonic Phantom making a comeback as Sonic, and not only that, but I happen to know that there's going to be a bunch of seigniorage, which is like UST algo stable type protocols launching over there, and least of which will be Andre Cronje's direct attempt at solving the algo stable conundrum. And I don't know. To me, it's worrisome if history is indeed rhyming, but maybe it'll be a slant rhyme, and this just means like this is the start of the bull market, not the bear market. Who knows? Patrick, do you have any feelings or sentiments on algo stables?
My feeling or sentiment on algo stables is that I want nothing to do with them.
They've always worked out. There was base.
Yeah, that's if I'm being honest, that's my feeling or statement. I don't plan on. If someone thinks they've figured it out, okay, they can try that, but I don't have to promote it. And the reason why is not because it's necessarily like riskier than, say, some random DeFi protocol that's probably going to go to, like that tries some other, leverage mechanism that, not related to stables that could collapse, right? Like maybe it's not more risky than that. The problem is that people treat it like a savings account, and that's how Anchor was basically marketed, in some part by the team, and other parts by people interpreting it like that. And so the issue I have with like why I don't talk about or won't be talking about an algo stable is that people are going to see that and they say, okay, I'll just use this as my savings account, and then they put money that they're not actually willing to risk in there. It's one thing to like try out DeFi with money that is risk on, that you understand you could lose, but like, I know people who had, they took money like out of their bank account to put in Anchor, thinking, okay, I get 20% instead, and then whoops, their savings are gone.
Does everyone remember that video with that young gentleman who was like, if you take out, you can buy a house with Anchor. If you put down enough capital into UST Anchor at 20%, then you can pay off your mortgage. So you can buy like a $500,000 house with $100,000 principal just using the interest. It was, there was a lot of pie in the sky math that led to a lot of
I remember
doom.
I actually know someone who, I don't know if they got a second mortgage or like revolving line of credit on their house during this time, and took that money and put it into UST on Anchor and lost all of it and lost their house. So there are very real stories of like, the pain that these things can cause. And I agree with you, Patrick, like the mechanisms for these things, very interesting. I'm not like inherently against like people building these things, but just the way they get marketed as being safe and being infallible, and like this like savings product where, you're going to earn 20% and year over year, and like all these projections that kind of go into them, that is very unsettling. And I hope if we do see another round of algo stables, it's a more mature approach to how they're discussed and the risks that are around them. And, I don't know, it's a little bit nerve wracking to see, as much as I respect Andre, him talking about, the scaling of this thing to hundreds of millions and billions of dollars, and how, it couldn't break down. And, maybe he's figured it out. Maybe he's cracked it. He's a very smart man. So I don't want to like fade him at all, but, people tend to get hurt. And also, inevitably with many kind of Andre's products, he'll build something and then people will fork him. And the forks of these things tend to be even more stable. So
that's exactly right. Whatever he builds, we're going to see people copy it near immediately.
Exactly.
And I also agree. I think it's going to be a systemic risk to DeFi, but I also think that most people won't treat it like Tether. I don't think we're going to see hedge funds enter into it. I don't think we're going to see like massive family funds say, let's just put a lot of money in there as a risk-free rate. The new risk-free rate is 20% or whatever it is. I think that would be absurd, and hopefully people will, regardless of what kind of magic he tries to work with his rhetoric, will ignore that and say, this is an algo stable. This is going to be effectively a Ponzi scheme. Enter it while it's hot, and then try to get out first. I did want to let you, Cyril, speak on the narrative, which is like soft liquidations, because I have mistakenly said there's no liquidations, and then I was rebalanced quite a bit, where like had I been on Aave, I would have zeroed my position entirely, but because I wasn't on Aave, I didn't zero my position, so benefit for not being there. But can you explain the rebalancing mechanism, the sort of what is called liquidation protection and how that actually works and what that means?
Yeah, sure. And actually, I've also said no liquidation at some point because V1 had no liquidations. But on V2, liquidations can happen, but they are very unlikely. And this is why we call this liquidation protected leverage. And thanks to a mechanism we call the rebalancing or liquidation break. And the way it works is that when you take leverage, whenever your exposition reaches and crosses 88% LTV, the protocol will put it back to 88% LTV so that your position never reaches the hard liquidation LTV, which is 95%. So the idea is that you keep the maximal exposure to the market so that you can recover with a market rebound and only close what's needed to protect the system. And so you can use this tool, which is made by a community member. This is an initiative from this guy, which is really awesome. And then on the blue line is ETH price. The yellow line is the rebalancing line. So that's the price at which the liquidation break triggers. And the red line is the hard liquidation price. So if you do like a downtrend, you'll see that when the price of ETH reaches the liquidation break line, it will the liquidation break line will follow the price of ETH and as well as the hard liquidation line. So you will see that you can never cross the liquidation price. So let's wait a little longer.
Flash crash that's like a super.
Then you can hit pause and uptrend again. And so you will see that when the market goes up again, you only closed what was needed to protect the mechanism. But
this tool is so cool. You like llama guys and curve guys are something special. This is cool.
Yeah, and this is I love the fact that it's just an initiative from a guy of the community, and that's really cool. So you see that you keep some exposure so you can recover with the price of ETH basically. So this is how it works on a different DeFi protocol. On a CDP, for instance, most of the time an ETH position gets liquidated around 85% LTV. Yeah. That means when the price of ETH would have reached the yellow line, at least half of the debt on Aave, for instance, it's half of the debt. On CDPs, it's 100% of the debt would be closed. So when the price of ETH recovers, if you didn't reopen your position, then you lost the market exposure and you sold at the worst moment. So this is how FFX works. The idea is that you keep the maximal market exposure and only rebalance what's needed. And the rebalancing cost as well is way lower than on a money market or CDP. Most of the time, the liquidation costs are 5 to 10%, and in that case, it's only 2.5% on the repaid amount. So let's say, for instance, sometimes there's just a couple of bucks repaid. You just pay 2.5% of these couple of bucks.
So my understanding is instead of getting kicked out of the position, having liquidation happen, and then getting some of your, getting a very marginal amount of your principal back as a stablecoin, as whatever debt asset you used, their margin asset you used, instead you get consistently rebalanced so that you stay in the position and also maintain upside exposure when or if the asset rebounds. And that's sort of the entire thesis here.
Yeah, that's it. And if you don't want this to happen, you can always adjust your position before reaching the rebalancing line by reducing the leverage or adding to the positions.
That was interesting, which is I know we're like going a little over time here, but I didn't realize that with X positions, you could add collateral. You can adjust. It's just like a perpex. You can change leverage. It's all the things you can do with the perpex you can do here, and there's a high LTV. Okay, we're gonna end there because we've gone a little bit over. But thank you, Cyril, so much for joining. Thank you as always, Patrick, for co-hosting. Mara had to run his house call on fire. I'm kidding, he didn't. He's fine. And everyone else watching, go check out FFX. There may or may not be an airdrop. Cyril, I'll give you 30 seconds to explain a little bit of alpha there. And you earned this.
I wanted to share it to you and your community first, but there might be an airdrop very soon for active DeFi users, and that could be an airdrop reaching multiple thousands of dollars for individuals. So I'm not saying more. It will be disclosed with more details, but yeah, there might be something happening. So if you want to make sure you don't miss it, just follow the X account, which is protocol_FX. And yeah, you won't miss anything. Or join the Aladdin DAO Discord. Aladdin is the DAO behind FFX, by the way.
That actually is some alpha, and
It is.
don't be the kind of guy who misses the claim. Like, if
Oh
they
yeah,
say follow the X,
yeah.
definitely follow the X.
There's going to be a short window to claim, so yeah, you don't want to miss it.
I will tell everyone that I know this. Thank you all so much for watching, and have a wonderful rest of your day.
Thank you.